we cross live to Hong Kong now and speak to Geoff Lewis, Head of Investment Services at JPMorgan Asset Management. A very good morning to you, sir. Thank you for being with us. We've seen the markets held hostage somewhat by those sovereign debt worries around Greece. What needs to happen now for investors to feel a bit safer again?
Well, I think we have to see some kind of preliminary agreement. Already the Greek government has agreed to try and reach the Maastricht debt criteria of 3% deficit GDP by 2012, although it's not clear that it can get there without substantial assistance. Now, I think basically what we're seeing is that early in 2010, investors are taking profits. Markets did run up very quickly, and everybody knows this is the transition phase to that part of the rally where we have to see earnings being delivered. Expectations are quite high, and emerging markets had risen more than most. So I think this is more of a global risk appetite, temporary reduction, nervousness. Also, we have things like the Obama tax proposals. We have China starting to withdraw policy stimulus. All these things are hitting that investors' confidence in the rally to continue. But the economic fundamentals are continuing to get better. And this is a problem for the peripherals of Europe. It's not a problem for Asia, where fiscal positions are a lot healthier. So I think we just need to sit tight, and money will start to flow back to these markets in Asia.
And do you see also this trend continue that emerging markets, especially in Asia, the likes of China and India, will continue to lead the global recovery? And where especially would you advise investors to put their money?
Well, I think we have seen value created by this correction now. We've had a 10 to 12% drop in the China markets. It's rather higher than the correction we've seen in the developed markets. And I think whilst a degree of nervousness is understandable at this point in time, if you look at the fundamentals, China looks pretty solid. And it's also quite interesting that the authorities have actually been quite proactive in this cycle. They were actually beginning to hold back on the infrastructure projects, and fixed asset investment has been declining in year-on-year terms since about last September, October, as private sector investment has begun to take over the running. So I would be more concerned if China wasn't withdrawing some fiscal stimulus at this stage. It's a sign that the policies have been successful and that now there is a self-sustaining recovery in final demand in China.
Just one concern, though, remains out there, which is inflation. And we've seen the latest inflation data from China showing us producer prices becoming much higher than expected, while CPI has been slowing down. But all this is likely to prompt the central bank in China to raise interest rates and withdraw stimulus and tighten lending. There is a big risk factor here.
There is a risk factor, and some of the forecasting models, ISI, bank credit analysts, are looking for the first quarter China GDP growth to be as high as 13% or so, a move up from 10.7 in 4Q 2009. That would, I think, signal tighter measures, more tightening. They haven't really done very much so far. But in terms of inflation, I think probably the PBOC has got a higher threshold than a lot of Western analysts would imagine, probably 3 to 5%.
We have to leave it there. Thank you so much, Geoff Lewis there from JPMorgan Asset Management. Now